Today, folks, Canada just saw 1 in 20 businesses close in a single damn month, which is the biggest wave since the pandemic. We need to talk about this as we take a look at the backdrop of Canada's economic circumstance, from interest rates to savings rates and unemployment, and how this bleeds over into your investments as the Toronto Stock Exchange is virtually sitting at an all-time high. As we break down those top 5 stocks to see how they're holding up in the backdrop of all these crazy headlines and this horrible economic circumstance that is becoming far worse than what we're currently seeing in the United States. And if you are on a path to financial independence to damn well one day retire early, subscribe, join me on that journey, and slap that like button as we dive into Canada's reputation as an ideal environment, maybe more hype than reality these days. And this is coming from Stat Canada, as Canadian businesses are shuttering at breakneck speed. Seasonally adjusted data shows 46,000 businesses closed just in June, marking the largest wave in exactly 4 years. That's right, the current environment is so damn rough that businesses are responding like it's the pandemic. Basically, the closure rate also set a similar pandemic record. The rate climbed to 5% in June, meaning 1 in 20 businesses closed their doors for good last month. And if that sounds high, that's apparently because it is. Even more disturbing is the fact that this issue is now widespread. StatCan observed closures across industries, noting it was a broad issue, right? It wasn't like one sector specific, as they did note that construction and retail were slightly ahead of the pack, which is kind of peculiar that retail is doing well. Maybe good for us RioCan lovers, some REIT lovers out there. But this highlights how weak households are these days. And since both industries should have seen a large boost just by sheer population growth, which we all know Canada's economy was largely being boosted on the record immigration, being basically of the G7 nations, the fastest population grower just by immigration. But we can see that Canada, basically between closure rates and opening rates, are exactly inverse in a very quick and dramatic pattern. Something we haven't seen since the pandemic, where all of a sudden a massive spike in closures and a massive decline in openings, which means less people are starting businesses and more people are closing their doors. We cannot have this trend continue. It is a trend that is becoming quite concerning when you look at the employment and the unemployment rates. We are now above the 2019 levels of unemployment, right? We're getting into the 6.5% range, and this trend cannot go on. We need interest rate cuts now. We need more aggressive interest rate cuts, and we know inflation is cooled to this point, but are we really going to continue to watch us slowly teeter toward the edge of a recessionary event when it could easily be avoided or dampened by just, continually cutting rates a little bit more aggressively? Because right now, the Canadian national savings rate is dropping. It's down by more than half from where it was before we started the interest rate cycle, which is quite concerning, right? Like, Canadians need more money. They're losing it on the renewal of their mortgages. They're losing it, even trying to buy cars. I know people that work at dealerships and they're struggling right now. Like, it is hard getting sales or any high ticket items that come with interest or margin expense. So we need lower interest rates to continue to stimulate the economy. And honestly, 4.25% is not enough unless you've got some money on the side. You want to lock in GICs and get some long-term, high-yield, really safe investments. That opportunity is now, because something tells me it ain't going to be here for long, and especially the more concerning the outlook looks, the faster the Bank of Canada is going to cut these rates. So what does it mean for our investments as a whole? Typically, anytime a recession is announced, the stock market is already bottomed. The stock market does not have to respond off recessionary events. It will more than likely respond off the bottom line, the cash flow, the earnings, the future expectations. And luckily in Canada, unlike the US, where the US is largely tech-driven, which again has benefited greatly to them, which is why I primarily invest in the US. But the thing that we have they don't is what I would call more recessionary proof oriented businesses that have survived much better and have shown more resiliency through tougher market environments, which is good for income oriented investors, right? Because we take a look at VCE, which is basically the S&P 500's VOO or SPY on the Canadian side of the border, with the largest companies in Canada being Royal Bank, Toronto Dominion Bank, Shopify, Enbridge, and Canadian Pacific Kansas City Railway, which we're going to take a look at these top 5 stocks just to see how they've been performing and if there's any stuttering going on currently in their businesses. Now, we have a lot of other great businesses in here that you can take a look at, but of course, these are, again, like the top 5 companies in the US. They're just what we have here in Canada. So we got to see how they're doing, right? The entire market is largely made up by these five companies. I mean, in this ETF, you got 5, 10, 15, almost 25% of this ETF is just in these five stocks. So it's quite incredible, right? So the performance so far has been a bit laggard and all over the place. Shopify surprisingly underperforming, the broader markets. Enbridge is just kind of keeping in line. You got Toronto Dominion that is flat for most of the year, and Canadian Pacific Railway is actually up 5 percentage points. But Royal Bank is the only one that is absolutely crushed, and I want to kind of give some insight into why. Firstly, if we take a look at the Royal Bank's revenue, and that's what we're going to primarily focus on is revenue, net income. Royal Bank has actually seen very nice net income growth, which is quite incredible. And I think it's prevalent to point out that they did purchase the Canadian counterpart of HSBC. And when these companies do acquisitions to help grow their bottom line, it kind of skews the real results of how the business is performing. But because Royal Bank is primarily exposed to the Canadian economy over, say, Toronto Dominion that has huge exposure to the US, they've actually been able to cushion themselves against some more of the economic blow that happened to the US banking sector because they had regional banks that were going under like crazy. Royal Bank has had a very good cushion, and it's now no longer really putting huge amounts of loan loss provisions aside, and they've avoided the very tough US regulatory environment that TD has been largely slaughtered by because of manipulation. There's been fines related to laundering money. They've had a hard time, and the revenue kind of reflects it as well. Their revenue has been stuttering since basically the last quarter of 2023, where we haven't seen like any record revenue growth outside of that. On an annual basis, it still looks pretty great over the totality of 2023. Annually, these numbers are going to look really great, but all these banks need from here is for basically loans to level off at this point and for them to be able to stop putting so much loan loss provisions aside. I'm still confident that the Canadian economy is going to ride through this tougher market environment, and that these banks have put themselves in a position of power. They've had, basically the last 2 years to put absurd loan loss provisions aside while they've continued to hit record revenue rates, which both these major banks have been doing quite successfully. And now I think we're going to start seeing that actualize even on the backdrop of badder economic data. Now, on the other hand, our only largest tech company is Shopify, and it has been trading at wicked premiums and continues to on the back of where we haven't seen a lot of growth in 2024, which should be quite concerning if you are an investor in Shopify, because what we've seen is the stock rally. Obviously, valuations go up, but revenue over 2023 hasn't really grown that much, and gross profit has been basically stagnating. Not something we want to see consecutively over 3 quarters in what should be a software-oriented business that is, one of Canada's fastest growing companies. So the software side, again, is still quite concerning with Shopify specifically, maybe not other software companies. You can take a look at Constellation Software. There's a lot of different software companies in Canada, but this one, like I said, it worries me a little bit because it has not come close to recovering to all-time highs. And it's one of the reasons that I don't own Shopify, because it's always traded at far too hefty of a premium. Whereas again, if you're a dividend-oriented investor, you look at the next one in line, Enbridge here, which Enbridge, I think, has been surprisingly one of the most stable, sought out, investments, being the largest pipeline company in North America. It is the blood flow of North America, and it proves it in the stability, not only in its revenue over the last year, steadily growing. They've been doing acquisitions. Their gross profit is steadily growing, even in the backdrop of a volatile oil market. Enbridge continues to be an incredible outlier with a wicked high yield. And same with Canadian Pacific Kansas Railway here. The railways have done exceptionally well. We take a look at the growth, very stable revenues over the last year. Gross profit continues to steadily increase with a few hiccups here and there, probably coming to just one-time expenses. So I really like, the railways if you're looking for like really recession-proof Warren Buffett-like investments. But when it really comes down to it for me, I am not as concerned as maybe the guy next to me that's struggling, that, just got his first job, doesn't have a huge savings rate. If you are like me, you need to put cash aside to deal with recessionary environments so you can protect your portfolio, because if headlines get bad enough, the stocks will start to underperform, right? Even though these were still the best investments you could have owned, they dropped 30% during the pandemic. But I am going to continue to focus on the dividend-oriented stocks that have more stability behind them and have, proven resilient through a multitude of recessions, like the Canadian banks. They have survived every economic downturn that has wiped out so many U.S. financial stocks, which is why I continue to buy VDY, which actually keeps almost an exact line performance with the broader Canadian market, or VCE, right? So if you want more diversity, by all means, you can buy VCE, but I still primarily like getting the higher monthly yield that has the concentration to things like Royal Bank and Toronto Dominion. I would not make this the bread and butter and the sole ETF in a portfolio. It's far too concentrated for that, in my opinion, not as financial advice, but I'm still buying this because you get, again, Enbridge, Canadian Natural Resources, all the major banks, Suncor, Manulife. You basically just get the infrastructure that is running Canada, which is beautiful. And these are the highest yielders that Canada has to offer. There's nothing saying that these companies aren't going to be able to survive any bad times. You need to use your banks. You want to pay your mortgage. You're going to fight for that. You're going to try and keep your heat and your hydro on. Enbridge. All these companies are resilient for those specific reasons, which is why I like having it as kind of an emergency income in my portfolio that can weather a lot of bad economic circumstances, right? And if we kind of do a quick comparable, VCE, the dividend growth rate over 3 years, let's take a look at the 5-year growth rate. This is 6.62%, which really isn't that bad. If we take a look at VDY, it's 7.98%. So concentrating in the dividend payers has actually yielded better growth, which is beautiful, and obviously a higher yield that is paid monthly. So I love all these stocks, and I do some comparables to even the likes of XDIV, which is another great, more concentrated dividend ETF you guys can take a look at. But at the end of the day, I mean, are you guys feeling this pain? Obviously, I'm seeing this with many clients as I work with many Canadian businesses, small businesses out there, and I see two sides of it. I see hyper-specific businesses still doing exceptionally well, but other businesses not doing so well. I don't know what this data is going to lead to, if it's a one-off event, but I'd love to know what you think in that comment section below.